Earlier this week, I sent out a video that we're starting to see a top in the market. So I wanted to take some more time to really dive into this for those of you that are interested in how this kind of stuff happens and what's the technical analysis behind this, show you some of the tickers. And then at the end of the video, I'm going to hop into a couple of options for you to invest in over the next couple months to years that have a ton of upside. And we'll talk about some of the things you're going to want to avoid for the next 6 to 18 months. So here on the screen, we have the S&P 500, the SPY. So for those of you that are unfamiliar with technical analysis, some of this is going to be new to you, but the stock market moves in patterns. And the best way to think about the stock market is that the chart moves first and the narrative catches up to what the chart does. So for those of you that are looking for some kind of catastrophe that's happened, that will catch up to the charts soon. We don't know what it is yet. There's a few catalysts out there that can be blamed for this, but the chart moves, according to these patterns. So let's take a look at some drawings that I've had on the chart for a few years. So we covered this a little bit in the videos last time, so I'll recap this pretty quickly. Back in 2020, we had the big COVID crash, set a new low. We had a pretty consistent run up through 2022, early 2022, and then it just kind of ran out of steam, which is normal. And so we had a nice little downturn here for about a year to the end of October. And then we started to pick up some momentum again. And so we have a couple touches of this trend line here. So until this point, we're not able to draw this trend line. This doesn't exist. But once we can connect 2 points on the chart, we can draw a trend line. And then from there on, the chart is going to start reacting to those trend lines because it's obvious every trader has that on their charts. So take yourself to the end of October here. Now we have this trend line. We have some consolidation here, and then price touches it again, gets a nice boost, comes back down, and then very clearly by now, every major trader has this trend line drawn. So you get another touch here, and you get a real quick push up because it's so obvious. This red box here is what's called a resistance level. So anytime you have an area where price slows down, you're going to want to take interest in that. So here the price came back down, digested that resistance level for a minute, and then busted right through it because it had momentum. So we had this nice push through 23 all the way until early this year when the new administration took over. Now, a lot of people think that some of the price swings are due to political events, and that's partially true. But when you're coming up on a trend line like this, the market has to react. Like I said in the beginning of the video, the chart moves first, and then kind of the catalyst gets blamed for it. That's more palatable for retail investors to understand. So when you have a big crash like this, what you typically have is both a trend line and a catalyst. So sometimes it digests for a while, takes its time, but a big drop like this is when you have a very clear trend line plus a catalyst. And I want to note that up until this point, it'd be really hard to draw this trend line at the top, but what you can actually do is duplicate this line, set it to parallel, and then establish this second trend line here. So we have technical traders selling, we have catalyst traders selling, and that's why you have this massive Liberation Day drop. So here in early April, we start to have some resolutions to tariffs. So the same thing applies here. You have actually a triple confluence here. So the people that have the trend line marked are looking forward to price being back at this level so they can get back in. So you have a ton of trend line buyers here. This former resistance now becomes a support. So all the traders that trade that type of setup also want to get back in at this level. And then you have some good news. So that's why you get such an aggressive push up here. And another thing to note is that as these trend lines become more obvious, the price moves much faster. So here, obviously the trend line had not been established yet. So you have some just kind of hanging out for a while. But as these become more obvious, they really move fast. So this is where we're sitting today. I'll zoom in on this a little bit. So we have a minor trend line here that goes into the major trend line, and we had a big break of that just the other day. And so one of the best tricks for getting a new perspective on the charts is to invert them. So turn them upside down. So the same drawing, but here we're looking at it turned upside down. So it's a good trick to just get your brain to think about it in a different way. Your brain gets stuck in a narrative. Oh, this is going up. Stocks only go up. But once you learn technical analysis, if you flip a chart like this, my brain is immediately saying, I'm going to buy this chart, which means I want to either get out of the market or short the market. So what we talked about earlier, trend line here moves really fast, gets rejected by what would be resistance since we're inverted. Come down here, and you'll notice that we make a new high, but not a significantly new high. So that's important, that there's a lot of exhaustion here. This moved really fast, and the market's just overcooked, and it needs to relax for a minute. So what we're going to see is we're going to see a little bit of hanging out here, probably similar to this right here, maybe a week or so. If something weird happens, we could see like an instant shoot through here. But we're most likely going to see a little bit of hanging out here. And then we're going to go back down to 530, 550 to 525. At that point, the market needs to decide if it's going to break this trend line or not. If it does break that trend line, that's going to be really bad news. And, we're going to have to make a lot of changes if that happens to our portfolios. But for now, we always target the next available trend line and then make a decision from there once we have the new context. So this is why it's important to get out of some of your big tech stocks and look somewhere else at some different options. So I'm going to take us into Thinkorswim, which is another charting platform which I use to execute my trades. It doesn't look as good as TradingView, but I like it. I've been using it for a while. It really helps with just placing the trades in there for me. So what do we have here? We have the S&P 500 inverted. We have our major trend line here. We have our minor trend line here. I've got some Fibonacci levels on the screen that I can get rid of for you. So again, this is inverted. At TradeEdge Pro, this is like our bread and butter setup. We like to see a major trend line break, which we had here, which was back in March with some of the tariff news. We found some support here, and then we're coming back down to retest that trend line. And then we have a break. So this is the exact spot that we want to hop into these names and buy here. So again, since we're inverted, that means we're going to sell. It doesn't mean you have to short the market if you're somebody who's not really interested in that. You don't have to do that. There's other ways to make money outside of shorting here. But for those of you that are aggressive, we'll talk about some ways that you can short this and make some really big money on this drop, because this is going to be a pretty violent drop here. So looking at some of the technical indicators that we have, you'll notice that the volume on this move is pretty high. Not as big as some of the tariff news back here, but we have above average volume. So that tells us that this is a real move. Here on the MACD, these are lagging indicators, so you have to be careful with them. I prefer the trend lines over the indicators. But what you have is a MACD divergence here. So you'll notice that when price is here, price is higher. Then we come here, the price is lower. Now on the MACD, we have a lower MACD with a higher MACD. So what that's saying is that there's a lot more buyers, or in this case, sellers, since we're upside down, jumping in here. So it's stronger and it's running out of steam. So we have the same thing here on the RSI. There's a strategy out there that some people use. You buy when it's under 30, you sell when it's over 70. It works okay. You definitely want some confirmations with that. It's not something you can just blindly do. But when it gets below 30, it's time to start thinking about making a change here. So we have the same thing. We have an RSI divergence here, higher price. And so we're starting to move out of that oversold zone here on the inverted chart. So what do I expect? I expect some chopping around in here. And I'm going to take you to the S&P 500 futures to show you that, because I do a little bit more charting on the S&P 500 futures. So with that, what we're most likely going to see in the next couple weeks is we've sold off pretty hard from our high, from our former trend line, and we're coming into this zone where price originally took off from. So you've got a lot of buyers here around 62.40, 62.20. Zoom out a little bit so you can get another perspective. So got a lot of buyers here. So we have to push through this level to really make that change into full bear market mode. And so as you'll notice on the 4-hour chart, which is a really big level, the RSI is already overbought. We've got about 18 or so. So anytime you come into a support level and you've got a really low RSI, what that means is this is starting to run out of steam already. This move happened too fast. It's most likely going to want to take a break. So what I'm expecting here, we're moving down in a trend line, obviously a very aggressive trend line. Can make this fit a little bit better. But we had a really fast move here. So what I'm expecting is that Wall Street typically likes to give itself the opportunity to exit these trades. So I always consider moves like this the warning shot. So this is telling big investors, hey, we're moving the market back down. We're going to give you a week or two to get out of your positions. But we just want you to know that this is for real, because you get a lot of fake outs up here at the top. So finally, the volume's coming in and the move is becoming real. So what's most likely going to happen is the market's going to move within this zone for like a week or two, and Wall Street's going to deleverage some of their long positions, some of their Mag 7 positions, and then we're finally going to see a breakthrough from this level. So once we get below this area, that's when the bear market's really on. So let's flip this upside down and see what that looks like for the 6,200 level. So you'll notice here, former highs, 6,200 level. So we're going to consolidate kind of in this corner for a while, which is really typical. This is our, like I said, our bread and butter setup, so we know exactly how price moves in this area. So we're going to consolidate here. Wall Street's going to deleverage. We're looking at about a month, and then we're finally going to push through that level, and that's when the bear market is really on. So keep an eye out for that. So let's go into some of the Magnificent Seven stocks and talk about why this is finally happening. So the last week, almost all the Magnificent Seven reported their earnings, and we'll start with Apple. We'll do these alphabetically. So on Apple, you've got a bearish trend line here that it finally came into. And again, we're going to use all inverted charts on this because it really helps the brain kind of understand what's happening. So with Apple, what you'll see is we've had this really clear channel of price moving up, topping out at 260. Right now, price is really wanting to exit this channel. So when you have a descending channel like this, it's found a low, it's pushed out, and it's consolidating here. You could probably call this a bull flag. And as soon as price pushes out of that line, sellers are really going to step in and drop this. So Apple's looking terrible right now. If you own Apple, now is kind of your last chance to get out. So let's talk about Amazon. Another really terrible earnings report at all-time high. Well, let me clarify that. The earnings report wasn't bad. The market's reaction to the earnings report was really bad, which is what happens when the stock is just too hot, like we see here. So again, we're going to invert it. We see a trend line here. You might notice that a lot of stocks broke their trend line in April. Typically, they respect these trend lines. I've been giving these names kind of a one-time pass because the news event really was a catalyst and kind of pushed them past the trend line, which isn't normal, but they hung out in that area. So I'm giving them kind of a pass on that for now. So again, inverted with Amazon, you see a double bottom here. So price doesn't want to go above 240. You've got some volume stepping in here, buying volume stepping in. So as soon as this breaks this trend line, Amazon is definitely going to go down from here. Let's take a look at Google. Same thing, double top, trend line into the double top. We'll invert this one too. So another little perspective here is we have an old trend line. This one was actually broken and is now retesting that area. So that's a great sign that this price wants to move down from here. So you've got some indicators like the MACD crossing here. You've got the RSI bottoming out. So at TradeEdge Pro, we typically trade off of support and resistance and trend lines first, but we look for things like RSI and MACD as confirmation. So I never use these as our first source for making a trade, but when you have a MACD cross on the daily, that's a good sign. When you have the RSI bottoming out, that's a good sign. So let's go to Meta next. Same thing, actually had really good earnings. And that was kind of the euphoric final push that Wall Street used to confuse retail. So retail sees that Facebook's crushing it or Meta's crushing it, and they want to get in, and they turned you into exit liquidity for these names. So going way back to the end of 2022, you've got a really clear channel here. Again, same thing, one time pass that it exited the channel, and then back in here. So this name might have a little bit left to it, but I don't think so. So as soon as this breaks this channel, expect some fireworks here to the downside. Now, Microsoft, same thing. Invert it. Former support here, and we had this euphoric push up. So for those that weren't able to get out at the high, now is a great time to get out. And we have a pretty simple trend line here. As soon as this breaks this trend line, Microsoft is in big trouble. So one of the things you'll notice here, the RSI on the daily has been bottoming out for months. And that's why, again, we don't use RSI as an entry, because if you entered, anytime it went under 30, you could have entered here, and then you're just getting crushed for months. So it's a secondary thing for us. But when you look at this chart, if I'm an investor, this is the chart I'm for sure buying, which doesn't bode well for the bulls on Microsoft. So you've got really low RSI in the 20s, which is pretty low for the weekly chart. The MACD doesn't have signs of turning or crossing yet, but if you're early, if you're looking at this early, it's starting to look a little encouraging. And then you have a bullish hammer candle here. So price moved out of that really quickly, and that just looks like it's ready to push through there. So same thing here. We expect a couple days of consolidation and then a catalyst that'll push this across the trend line. And that's when it's over for the Microsoft bulls. Now, NVIDIA has been the biggest name. I think it's the biggest market cap. If not, it's close. We're going to invert this. Really similar chart to Microsoft. We've got this trend line here. We've got this euphoric push. We've got some MACD divergence. We've got some RSI oversold for a long time. So when you see it oversold for a while, that's a pretty sure sign that it just can't keep doing that forever. So on NVIDIA, once we see this break, this name is going to go down. And last one, Tesla. This chart's pretty marked up because I trade this a lot. But let's invert it and clear it up a little bit. So this one looks not as bad as the others, but still from here, we're probably seeing we're seeing a triangle pattern here. So once this breaks to the upside, which in reality is the downside, you can see quite a bit more downside here. So Tesla's not as clear as some of the others, but definitely some worries there. So let's talk about the VIX next. So these are VIX futures. The VIX is the market volatility gauge. So when you see spikes like this, this was the Japanese yen crisis back in last year. This was the tariff crisis. So when the VIX spikes like this, you typically see some really aggressive downside in the market. So when it moves between about 15 to 30, that's pretty normal. And charting the VIX is a little bit different than charting stocks because it stays range bound, and there's some weird things about the VIX that they say you can't chart it, but there's some ways that you can. It's just a little bit different. So we've got a trend line break here, which kind of gives us a secondary confirmation that things are about to get pretty spicy. So anytime you come into this support here is a great time to deleverage your stocks. And then we have a trend line break, and that means we have a change in character here. Another thing of note is the US dollar index. This is the DXY. When you zoom out, we've got a pretty interesting bull flag here. So we're moving within these channels. So anytime prices touch this channel here, we have a move up, here, move down. And we've got a trend line break here. So what you're seeing is an aggressive move up. It's going to consolidate here in the corner for a second, and then we're going to see a big move back up into 108. So with the US dollar index, it's not necessarily 100% correlated with the stock market, but typically when there's a high US dollar, that is kind of wind in the face of stocks. Now, it doesn't mean they have to go down, but it just means that they're fighting through some wind in their face. So when we see some really bearish charts and we see bullish US dollar, you put the context of those two together, and that starts to create some concern. So again, just kind of like a secondary indicator, just adding a bunch of context together. And once you have all that context, you can get a good perspective. So now that we've gone through what we're seeing in the market, what actions do we need to take? First of all, if you own big tech stocks, I want to be super clear about this. Please sell them. The risk reward is not in your favor. That's something that we've talked about a lot in our program, that a lot of people get FOMO. What if it goes up without me? It's not. At this point, take your money, go home, either sit in cash, or we're going to talk about some other places that we've alerted where you can put your money. So first one here, we're going to go to TLT. So this is a BlackRock 20-year Treasury bond ETF. So this is really tied to the interest rates at the Federal Reserve. So in terms of a catalyst, well, on the technical side, we've got support here where price really doesn't want to go below, let's say 82 to 85. Um, and we're really starting to consolidate here and pick up steam. So we're in a great buy zone here at 87. Anything below 90 is a really great time to buy this. But in terms of a catalyst, there was a news report on Friday that the economy is starting to really hemorrhage jobs. And actually, the day before that, the Federal Reserve refused to lower interest rates because they felt that the job market was too strong. Um, and so all of a sudden, it's starting to become very clear that the Federal Reserve needs to cut rates and they need to do it soon and pretty aggressively. So people are loading up on this ETF in anticipation of that happening at the next meeting, which is in September. So if you look on a smaller time frame, actually we just broke out of this trend here. And then we've got a bigger picture trend line here. So it's going to consolidate here, give you a chance to buy, and then move up out of this zone. Our first stop is about $100, but this has plenty more upside to 130, 150. So this is the most conservative yet great idea coming up in the next 6 to 18 months. And we've talked a lot about that in our program, that this is a great place to have your money for the next year or so, especially if you're closer to retirement, if you're in your 50s or 60s and you can't afford to be as aggressive as some younger investors who really want to grow. This is the number one thing I would recommend to, say, an older investor that wants to be more protective. For those of you that want to be aggressive with this same play, there's a ETF called TMF. And so this is a 3 times leveraged ETF of the same concept, TLT. So you'll notice these charts are almost the same, not exact. That's how these 3X's work. But same thing here, right at the 35 to 40 range. Great buying opportunity. I've owned these since February when I started TradeEdge Pro and deleveraged some of my stocks. So I've been going sideways for a while, but it's finally time for these to shine. So with the 3X leverage, for every point that TLT moves, this will move 3 points. So here, we're looking at a resistance of about 70. So this has almost 100% of upside in the near term. I expect this maybe by the end of the year. And then a lot more upside into 150 and 200. So this one's got a multiple bagger in it. So if you want to be aggressive, if you like the TLT play, but you're okay with some volatility, this is going to be probably one of the best places to have your money for the next 6 to 18 months. Let's talk about something that's a little bit more defensive. This is Kier. This is also a 3X ETF. I love these 3X ETFs. You'll pick up on that. Not super clear on the chart here. There's still a little bit of uncertainty, but healthcare is a defensive sector. So when the risk comes off of big tech, the money has to flow somewhere else. And healthcare is going to be that. Healthcare is beaten down. Its ratio as compared to the S&P 500 is the lowest it's ever been. So it's a great opportunity to buy Kier here. You see we've got a kind of a minor support level here at $68. So anywhere in this zone is a good place to buy. If the market gives you a chance to buy it between 55 and 60, which is still a possibility, incredibly great time to jump in to that. So upside there is 100% at 140. You could actually see this push through that and above. So again, 3X ETF, a little bit riskier, but this is a great defensive sector to get some money growing in the next 6 to 18 months. Novo Nordisk, pretty crazy chart. Got a lot of stuff drawn on here, but last week they released some news that they're not expecting as much growth as they used to. And we sold off into this really clear support level here at 48. So we've got an alert out for this on our platform. I've owned it since about $67, so a little underwater now, but not really sweating this in the long term. If you're able to buy this under, let's say 55, there's a great risk to reward ratio. And so one of the things we talk about in the program, like I talked about earlier in this video, you have a long-term trend line, it breaks, and then price always retests that trend line. So that's right where we're at right now. This is completely normal price action. Be careful of getting too wrapped up in the headlines. Wall Street uses the headlines to push price into these levels. So what you're going to see is Wall Street is loading the boat here while retail is getting frustrated and selling the stock. So this is the optimal time to buy a stock like this for further upside. And you're going to see a quick recovery as it shoots this gap. The volume here, a lot of people are capitulating, which is what you want to see. That's when Wall Street moves the price. And this does have earnings next week, so this will react to earnings as well. So to end the video, I want to share with you two really aggressive ways to short the market here in the near term. And so in our program, when we talk about shorting the market, I refer to it as what I call a tactical short. So holding a long-term short on the market for years is a terrible idea. The market always goes up and to the right in the long term because of money printing and things like that. But there are some times when it's okay to pop in, short it for a few months, and get out. And these 3X ETFs are the best way to do that really aggressively. So again, if you're a conservative investor, if you're near retirement, I wouldn't recommend this to my mom. But if you're a younger person and you want to grow your account aggressively and you have a high risk tolerance, this is a great way to do it. So this is a high beta bear 3X. So this is one of the fastest moving charts you can think of because these are already fast moving names multiplied by 3. So we'll zoom in here. There's a lot going on this chart, but you'll notice that we've got this trend line here that just broke. And so that's, pretty reminiscent of the market overall. If you can buy this for under $10, this can quickly go to $20 and double within a month or two. So targets for this, 20, 30, 40. And then from there, I wouldn't get too aggressive with it, but I think we're looking at a pretty unique situation in the market right now. And then last one, TECS. So these are technology companies. And so when we talk about the Mag 7, it makes up a huge percentage of the S&P. It's the reason that the market has done so well. Most 93% or 493 companies in the S&P 500 honestly haven't performed that great over the last couple of years. It's only been 7. So the technology sector is due for a massive correction. That's where a lot of the losses are going to come from over the next couple of years. So getting into this now, we had a trend line break way back there, but same thing. You'll notice that a lot of these charts are so similar. We have a trend line break here. We broke it with volume, which means it's real. So if you can load up on this for under $30, you got plenty of upside to 60 and 90 and 100. So these are some of the names that I'm going to be getting into this week in some of my more aggressive portfolios so that I can actually capture some gains from this downside instead of just sitting it out. So yeah, thanks for sitting through this video. I think that this is an incredibly important time to act and not sit on your hands, not stay invested in those tech stocks. Their run is over. I want you guys to succeed and continue growing your account. And one of the things that we preach about at Trade Edge Pro that separates this method from your advisor is that your advisor is going to sit on his hands. They're going to say, wow, there's not much action we need to take right now. And you're going to suffer 10, 15, 20% downside throughout the end of the year that could have been avoided. So just trying to get the warning shot out there. The market is topped. It's time to take action. And here's a couple good opportunities for you. So we'll see you throughout the week. Make sure to check out, if you're not a member of Trade Edge Pro, go check us out, tradeedge.us. Get signed up. We've got plenty of different opportunities for you to get invested. I think we've got 60 alerts that are active right now. About 40 of them are still in their buy zone. So those are things that are all going to hold up during this downturn. So go check those out, and we'll see you soon.